You sell 90 RSUs today, 70 next year, and suddenly your tax sheet looks like a bug report. Same stock, same company, but not the same cost, not the same holding period, and definitely not one average number.
If you are an engineer, the clean way to think about this is not one portfolio balance.
It is a queue of small packets, and every vest date creates a new packet with its own cost and its own clock. Once you see that, partial sales stop feeling mysterious. They turn into lot matching, basic subtraction, and one boring but important rule: do not average costs across vest dates.
Before the math, remember there are two tax moments.
At vest, the fair market value is treated as salary. Later, when you sell, capital gain is only the change from that already taxed value to your sale value. That single idea prevents the most common mistake. You are not paying capital gains from zero. Your base cost is the fair market value that already got picked up under salary when the shares vested. And when shares sit in demat form, the tax department says the holding period is determined using FIFO, first in, first out.
So the earliest shares entering the account are treated as the first shares sold. Now let us make this concrete with one example you can reuse in a spreadsheet. Assume you receive 3 vest lots of 80 shares each. The first vested at 120 rupees a share, the second at 150 rupees, and the third at 210 rupees. Those vest values are not just history. They become your cost basis for capital gains. So your 3 salary valued lots are 9,600 rupees, 12,000 rupees, and 16,800 rupees. So far you have not sold anything. You only have 3 separate lots sitting in the queue, waiting to be matched against future sale orders. Now suppose sale number 1 is 90 shares at 260 rupees each, with total brokerage of 900 rupees. That means your net sale value is 250 rupees a share, or 22,500 rupees overall. Here is the part people skip. You do not compare those 90 shares with some blended average vest price. FIFO forces you to consume the oldest lot first. So sale number 1 pulls all 80 shares from vest 1, and then 10 more shares from vest 2. One trade, yes, but 2 different cost bases and potentially 2 different tax buckets. Now add the holding period test. For unlisted shares, the ITR guidance says long-term starts after 24 months. In this example, the oldest 80 shares qualify as long-term, while those 10 shares from the second vest are still short-term. That is why one partial sale can create both long-term and short-term gains at the same time. The broker confirmation may show one execution, but your tax working has to split the trade lot by lot. Let us do the subtraction. The 80 oldest shares have a net sale value of 20,000 rupees and a cost of 9,600 rupees, so that lot creates long-term gain of 10,400 rupees. The next 10 shares from vest 2 have sale value of 2,500 rupees and cost of 1,500 rupees, so they create short-term gain of 1,000 rupees. Put the 2 pieces together, and sale number 1 creates total realized gain of 11,400 rupees. But notice the important detail, that total is not one tax rate number. After that trade, inventory is not gone. You still hold 70 shares from vest 2 and 80 shares from vest 3, for a remaining balance of 150 shares. Now sale number 2 happens later. You sell 70 shares at 300 rupees each, with 700 rupees of brokerage. Net sale value becomes 290 rupees a share, or 20,300 rupees in total. FIFO still has not changed. The next shares to be sold are the remaining 70 from vest 2. Vest 3 is newer, so it stays untouched. Because enough time has passed, those 70 vest 2 shares are now long-term in this example. Their cost is 10,500 rupees and their net sale value is 20,300 rupees, so sale number 2 creates long-term gain of 9,800 rupees. That means across both sale dates, your realized long-term gain is 20,200 rupees, your realized short-term gain is 1,000 rupees, and your total realized gain is 21,200 rupees. And your inventory journey also becomes easy to track once you think in lots. It moves from 80 shares to 160 to 240, then down to 150 after sale 1, and finally down to 80 after sale 2.
If your long-term gains in this example are taxed at 12.5%, that long-term piece alone would create tax of 2,525 rupees before cess. The short-term piece would follow the normal slab rate, so at a 30% slab it would add another 300 rupees before cess. Notice what we did not tax yet. The 80 shares from Vest 3 are still sitting in your account, so there is no capital gain on them until you actually sell them. This is why portfolio screenshots are useless for tax calculation. Tax needs a transaction log, vest date, vest FMV, quantity, sale date, sale price, selling charges, and the lot that got consumed. Common mistake number 1 is using one average cost for all shares. Common mistake number 2 is treating the latest vest date as the holding period for the whole sale. Common mistake number 3 is forgetting that brokerage reduces sale value. The spreadsheet structure is simple. 1 row per vest lot, then 1 row per sale match. Once that is in place, each matched row needs just 5 things: shares sold, cost per share, net sale per share, gain, and whether it is short-term or long-term. If your broker exports realized gains by lot, great, use that as a starting point. But still verify the vest FMV, because that cost base has to tie back to the salary taxed value for each vest. So here is the entire mental model in one line. Vest creates cost. FIFO chooses the lot. Net sale minus the lot cost creates gain. Holding period for that lot decides whether the gain is short-term or long-term. If this helped you finally untangle partial RSU sales, subscribe to WealthCode. We break India personal finance into clean systems you can actually use, not vague tips you forget by Friday. Next, we are going to break down how to choose between the old and new tax regime for software engineers using salary, bonus, RSUs, deductions, and real take-home impact instead of generic advice.